26 years of CNBC-TV18.
Today we inaugurate our Outlook 2026 series, where we will ask top economists and market masters how they see the year ahead. The current year, 2025, was a Goldilocks one, with growth at nearly 8%, being far better than what the Reserve Bank or the budget or economists on the street estimated. Likewise, inflation, averaging almost 2%, was lower than any forecast that we got earlier in the year. Will the Goldilocks continue? And if it will, why is the rupee struggling? What is the call on the rupee next year? Another 3% depreciation from current levels? Well, let me kick off Outlook 2026 for all these questions with Chief Economist from Citi India, Samiran Chakraborty. Good morning, Samiran. Thank you very much indeed for joining us and kicking off the Outlook 2026 series. First up, this Goldilocks scenario, growth being 7% plus and inflation being 4% minus, less than 4%. Do you think this can be our good fortune in 26 as well?
Good morning, Latha. Thanks for having me. This particular two numbers that you have said about the 7% and 4% higher growth being higher than 7% and inflation being lower than 4%, both things can continue in 2026 as well. However, just incrementally, it looks to us that the next year's growth will be a tad weaker than the current year's growth, and next year's inflation would be slightly higher than this year's inflation. On growth, the main argument is that most of the stimulus, both from the fiscal and monetary side, has been done this year itself. So next year, with the space of stimulus coming off, even if the global headwinds recede a bit, it might be difficult to repeat the same performance as in 2025. On inflation, the primary argument is mean reversion of some of the inflation momentum, as well as the base effect kicking in next year. These two things would imply that we would probably be inching up on inflation, but I don't see next year inflation being such a concern which will prompt any sort of policy tightening pressures.
Okay. But the Reserve Bank has started on the note of being higher and then lowering, which is what they did for a better part of this year. They started the FY26 number with 3.7, then came down to 3.1, then 2.6, and now standing at 2. It was a serious revision down, and they have begun that process for the next year. For April, May, June, their first forecast was 4.9. It came down to 4.5, and now they are at 3.9. So can we see that revision lower as well? At the moment, they are averaging a little below 4. If the trend continues, it should be way below 4, isn't it?
So if you decompose this forecast revision for the current year, we started off with 3.8 and we are now at 2%. So this 180 basis points of inflation forecast revision that we have done, about 100 basis point is because of vegetable prices, 40 basis point is because of non-vegetable other food prices, and 40 basis point is because of core inflation, which is primarily due to the GST cut. So it's not that the fundamental trend inflation forecast has gone very different through the course of the year. It has been these idiosyncratic factors which has caused this massive revision in inflation this year. And next year's we are seeing is partly this momentum just being passed on for the first couple of quarters. But I suspect that we might not be as lucky to get all stars aligning the way it aligned this year for next year's as well. We'll have to be very lucky for that. We have to have another year of such benign vegetable price inflation. We have to have another year of China deflation impacting us positively on the inflation side, and another year of maybe another rate of GST cut. Can all of this happen together to have inflation to be even lower than what we are projecting now? I think that probability is a much smaller one right now.
You kind of answered my next question, which is that are you seeing a structural fall in inflation? Are we not anymore even a 4% inflation country? We are probably a 3.5 or 3 to 3.5% economy?
That's a fair question to ask and debate and do more research on, because clearly now, almost 2.5 years, we have got extremely benign core inflation numbers, closer to 3% or so. So at least on the core inflation side, there's comfort that this is not just a 2025 phenomenon. It has been continuing for a while now. But clearly, we always see food prices creating sort of a volatility around this core inflation number. And we've been lucky that this year the food inflation has been significantly lower than core inflation, which has dragged down the overall headline inflation number. But even on core inflation, I think the question that we are all grappling with is that to what extent this is because of improved supply versus lack of demand.
Yeah, that's the point.
I think that's the debate that we'll have to settle as we move into next year. We're going to have a new CPI series, maybe that throws up a better set of quality of inflation numbers as well, which will give us some clarity on this very important question that how much of this decline in core inflation is supply side versus demand side.
Okay, no, for the GDP picture, also we need the inflation numbers right, because while, we may have grown well this year, a large part of the extraordinary surprise in GDP has come because the deflator is low. So, that's why I was dwelling so much on the inflation number. Time permitting, I'll come back to GDP. Let me first get the rupee issue out of the way. The shock of this year, despite a strong GDP growth, has been the fall of the rupee. Do we repeat an average 3% fall next year?
So what has happened is that the current rupee level is very difficult to explain from the standard valuation matrix that we have tracked in the past, like the 40-country RER and all. So rupee is significantly undervalued on those metrics. Now, typically, the economists start of the year thinking of rupee depreciation vis-a-vis the inflation differential. This year, the rupee has not moved at all in line with the inflation differential because India's inflation was significantly lower than global inflation. So by that logic, rupee should have appreciated rather than depreciated. So this is a very peculiar year where the rupee has followed more the BOP than the inflation differential. And this is an unprecedented thing that after 1991, for the first time, India is likely to witness 2 consecutive years of BOP deficit. And that has put pressure on rupee. So our view is that as we move into 2026, in the first quarter, the Jan-March quarter itself, there's a possibility that the BOP turns into surplus, partly because current accounts is seasonally stronger in that quarter, and partly because we expect some capital flows to also come back. Now, if that works out according to our expectations, then there's a possibility that the RBI can put some floor on this rupee depreciation, and we could see some even appreciation bias coming in at that point of time. If that holds up, then possibly next year, when we are again expecting BOP surplus, then the inflation differential comes back into play. And because rupee has depreciated much more than inflation differential in 2025, we could see even a catch-up next year where rupee does not depreciate as much as other countries that year. So we are looking at a 9 to 12 month target of around 91 on the currency, knowing fully well that this is not to say that rupee will never breach 91. It's more to say that where a more stable equilibrium would be reached is around that level. This is now a much more volatile currency, so there is always this path could be a very choppy one too.
Yeah. Your Outlook 26 also includes the stock market guesses in your last part of the report, and you're guessing that the foreign investor is going to return, but I'll reserve that for your equity team. Let me get to bonds. You have a very interesting chart of, how much of bond issuances you are expecting, state government and central government in FY27, and then you're comparing it to FY26 and pre-COVID. If you look at the level of pre-COVID bond issuance, it is about 10 lakh crore, And next year, you're saying that state and centre will issue over 30 lakh crore. I mean, is there not going to be, whether or whatever the Reserve Bank does to interest rates, it looks like there is going to be an upward pressure on the 10-year.
Yeah, so this is the sort of macro challenge for India, that while growth inflation balance, as we started off this discussion with, that it's a Goldilocks situation for India. The challenge is that the fiscal and the BOP, the two balances, they are more difficult going forward. We have been getting enough demand to sustain this supply in the last few years, with some help from the RBI OMO demand. But as we move forward, the redemption pressure is also increasing quite substantially. So the need for RBI to support this bond market will be even more, especially because we are now coming very close to the end of the rate cutting cycle. So obviously for different actors, their appetite to hold on to these bonds is, or buy new bonds, is going to be that much lesser as we come closer to this. So some widening of the term premium at the end of the rate cutting cycle is just but natural. The only question is that at what level of widening of that term premium RBI would think that the relatively easier monetary policy to support growth is getting challenged. And to that extent, they will have to do OMO to support this. Last year, we have also done almost a 6 trillion rupees of OMO. That's while we are comparing the 10 trillion supply with the 30 trillion supply, we have to also say that we have never seen a 6 trillion a year OMO from RBI. So that trend, I suspect, would have to continue if this bond market has to be supported.
Okay. Well, this year the RBI supported liquidity by buying dollars till their face was blue. Next year, probably they will buy government bonds, in huge quantities, probably in unprecedented quantities, to keep the liquidity going. Out of time, Samiran, thank you very much for kicking off our Outlook 2026 series with the news that we may continue with our Goldilocks scenario. Higher than expected growth, lower than average inflation. Wrap up on this Outlook 2026 series. Time for a break and then Chartbusters.
"26 years of CNBC TV18.